Let me now bring on board Saurabh Mukherjee, Head of Equities with Ambit Capital. Saurabh, good morning. Thank you for joining us. Saurabh, on paper, it is impossible to make a bull case, but are you surprised with the resilience and with the strength of Indian markets? In just 2 trading sessions, Nifty has regained about 140 points.
I think it is fashionable at this juncture, not just in India, but globally, to be bearish on India. And as you're saying, it's easy to think of reasons for being bearish on India. But there's a few factors which are worth keeping in mind. Firstly, the VIX is at very low levels, mid-teens, and VIX at such low levels does indicate a considerable degree of investor risk appetite globally. The second thing is fund flows are improving for Western fund managers. So both in Europe and in America, I think fund flows are picking up. At some stage, that will translate into some flows into India. We had a great Q1, but I think even going forward, the flow picture should remain all right. I'm not saying it's going to be as good as Q1, but it should be all right. And the third thing is, we are at the beginning of a mild economic recovery and a mild rate cutting cycle. It's not going to be 50, 100 basis points of rate cuts from the RBI, but even 25 to 50 bips will lift sentiment vis-a-vis India somewhat. And I think those three positives are holding India up. My sense is Sensex 19,000 is a pretty reasonable target for investors to have over the next 7-8 months.
Saurabh, hi, morning. Another key factor that, most experts are sitting up and taking notice is that yields are pretty high in the market at a time when liquidity is fairly tight. And while there are all noises from the RBI that interest rates perhaps would come down, it hasn't quite happened till now. How do you think equities would behave in this light?
The main difference, if we leave aside the political news flow, I think the main difference in our perception of the market over the last 90, 120 days has been the rate cutting cycle. At the beginning of the year, we were hoping for something between 75 to 100 basis points of rate cuts over the first 9-10 months of the year. Now our sense is it will be somewhere between 25 to 50 bips of rate cuts between now and Diwali. A mixture of higher oil prices, excise hikes, service tax hikes, the expectation of further fuel deregulation in the country has led to both us and other pundits pulling their rate cutting expectations back. The main casualties of that have been over the last couple of weeks and will be going forward banks. I think that the market's expectations vis-a-vis banks will get pulled back, and share prices of banks will be under pressure in the coming few weeks, I fear.
Sort of consumer names or defensives, they normally tend to outperform when there is global uncertainty, when global liquidity is tight, and when interest rates are threatening to go up. Right now, the environment is pretty much the opposite, which is global liquidity is easy, interest rates will come down, capex cycle has started. So in this environment, why are defensive stocks or consumer names outperforming?
I guess what's happening today in India is that we are on the cusp of an economic recovery, of a mild economic recovery. But the big difference between this economic recovery and say what we saw in FY10 is that the rate cutting cycle won't be particularly pronounced. Secondly, what's held investors back from betting on power, infrastructure, real estate, construction in a big way is the hammered state of balance sheets in those sectors. Most of these companies have debt equity north of 1 times. Pretty much their entire free cash flow will go into debt servicing. So if you combine a mild rate cutting cycle, I reckon for the end user of funds, whether it be a retail or a corporate user of funds, I don't think there'll be any meaningful drop in the cost of funds in FY13. And hence, if you combine that with very stretched balance sheets, it's difficult for institutional investors to bet big on the cyclicals. As we also mentioned, banks are the other cyclicals, and once again, the quality of banks' balance sheets is making investors wary of betting big on banks. Therefore, the money really has no other place to go, other than betting on auto and auto ancillary and say light industrials. There really is no other place to go other than having to bet on consumers, and hence the relatively robust performance of consumer stocks.
Saurabh, what is the future of Coal India? At current levels of sub 350, is Coal India a great contra buy?
We don't cover the stock, and partly because the governance of the stock is such that most of our client base abroad sort of refuses to countenance looking at it. The governance is obviously a matter of public debate at the moment. From a fundamental perspective, given how the government is treating Coal India, I would think very hard before buying those shares. It's pretty much being used by the government of India as its sole property. That the interests of minority shareholders really don't seem to matter for much. So I think it'll be a brave buyer who goes against the face of presidential diktat, literally against the face of presidential diktat, and chooses to buy these shares.
Sir, what about earnings? Because that is going to be another trigger. FY12 has been pretty bad. Do you think in FY13 we could scale up, say, in the next 3-4 quarters?
I think earnings pressure is bound to continue. Input cost pressures continue. Brent at 125 will unleash another wave of input cost pressures over the next 2 quarters, both Q1 FY13 and Q2. Higher interest costs which are flowing through the system will hit companies. Top line growth, which was the saving grace in the early quarters of FY12, has, I think, cracked now. So I think the first half of this year does look very weak from an earnings perspective. Our hope is that somewhere at the halfway stage, somewhere around Diwali, GDP growth starts recovering. We go north of 7% on a quarterly basis in Q3, Q4. I think it's in the second half of the year that GDP growth recovery will drive an earnings recovery. But first 2 quarters will be very muted for earnings growth.
Saurabh, if at Ambit your view is that the Sensex could touch 19,000 soon, which is a 15% appreciation from current levels. So which are the stocks do you think will appreciate by 30% in the next 1 year?
The place where we are holding out high hopes is the better names in auto. So, for example, Eicher is probably the best auto play in the country at the moment. And then amongst the auto ancillaries, a name such as Exide, a champion franchise over the last many decades and a champion stock over the last 20 years. I think Exide is well placed not just to benefit from the recovery in the auto cycle, but also from the replacement demands. I think auto sales 2 years ago were very strong, and that will help Exide's sales going forward. So both of these stocks I can see somewhere around 10 to 20% upside over a 6-month period. The 12-month outlook it can be more optimistic if GDP firms up, GDP growth firms up at the half-year stage. The other space we are getting very interested in is the light industrial space too. So, for example, genset manufacturers such as Cummins, such as Kirloskar oil engines. Gensets tend to be short cycle recovery stories. So, very quickly, once the economic cycle recovers, generator companies tend to see demand coming to very quickly. And Cummins is probably the best play in the space, but it's priced as such, 21 times earnings, I think. Kirloskar at 10-11 times earnings is worth looking at. Another interesting name we're looking at is Greaves Cotton. It's in effect an auto ancillary place. It supplies engines to the Tata Motors of the world, the Piaggio's of the world. I think the next version of Tata Ace will have Greaves Cotton engines in it. Once again, at something like 11-12 times, it's a nice stock to buy at this juncture of the economic cycle. So to put it in brief, low or no debt, cash generation, decent management teams, and nicely exposed to the economic recovery which we are about to enter.
Saurabh, what about the big contra bet which has worked out very well year to date, cement as a pocket? Is there anything you like there?
I think cement has done well for our clients over the last 4-5 months, and Ultratech was our top play there. Gujambuja was our second play. It's worked out well for clients. Have to admit, at this juncture, I'm struggling to see how our clients will get more than 4-5% upside in cement in FY13, unless there's a big pickup in economic growth and a real revival in economic confidence, which, as I was saying, is at least 6 months away. Unless you see that sort of pickup in economic growth and construction activity, it's difficult to see how these stocks sort of outperform from this point in. In terms of EV per ton, enterprise value per ton, they're trading close to lifetime highs, and that does worry me. Where I think our clients have done well YTD calendar year to date is names such as Axis and SBI, But I think those are the stocks where investors should consider taking some profits, because the earnings season, each successive earnings season will get harder and harder for the banks. And if over and above the underlying economic difficulty, the RBI does impose dynamic provisioning on the banks, which is something it suggested last Friday. If the RBI does impose dynamic provisioning on banks, then FY14 earnings growth could be pulled back by as much as 15-20%. So on the big banks in India, we are increasingly cautious as we come to terms with the difficult economic environment and what it means for NPAs and restructuring.
Just to counter that argument, Saurabh, banks are a proxy to economic growth. So at a time when we are bullish on the economic growth, why are you bearish on banks?
Agree with you. It's just that our positivity vis-a-vis economic growth is relative to consensus. I think consensus is somewhere around the 7% mark. We are at around the 7.3, 7.4% mark. Our sense is the economy will pick up, but it will be a second half economic recovery. Our sense is also that the rate cutting cycle will be pretty muted. Both of these factors make us very cautious vis-a-vis banks. Typically what happens is in a normal economic recovery, the rate cutting cycle is relatively aggressive in the first year, and the banks are able to hold on to a lot of that rate cutting. So if rates are cut by 100 basis points, say, the banks don't pass more than 50 basis points of that on, and hence the NIMs expand quite considerably. This time around, I don't see the scope for that, especially in the first half of this financial year. So in the first half, I think that the earnings will be under pressure from asset quality without any positivity, any positives from the net interest margin side.
Saurabh, final question, and I'm going to ask you a difficult one. We've discussed ideas, we've discussed sectors, and we've discussed some concept stocks. But personally, where are you investing this year? In fixed income or in equities?
I've got a fair bit of my own money in FMPs, which are giving me 10-11%. And to the extent that I'm putting money in stocks, I'm choosing a couple of small and mid-cap funds run by respected fund managers. I won't name the houses, but they are sort of well-known small and mid-cap funds. My sense is valuations at this juncture are relatively undemanding, and with India being on the cusp of even a modest economic recovery, small and mid-cap stocks should do relatively well, provided the fund manager makes his picks selectively. This isn't a year for speculation, but for stock pickers, for good stock pickers, I think this is as good as it gets. Really, you've got a decent economic climate, no great macroeconomic impulses either from within India or from abroad, and a very good environment, I believe, for stock picking. And hence my bet is that a good small and mid-cap fund should give you decent performance this year.